I can't hear you.
Hello, can you hear me?
Yes, now.
Okay, sorry, there was some problem. Okay, so let me start. So today's topic of discussion is on lending to unbankable entities, those who are that means financing the perceived high risk customers. Let's, ladies and gentlemen, yeah, there is an echo coming. So, Meghna, are you on a speaker?
Yes, but is the echo
Just,
better? I'll be on mute when you.
Okay, just put it on mode, yeah. So, ladies and gentlemen, just to give you an indication, there's a small town called Mangamathi. It's a neglected community of marginal farmers and low-wage earners who have no reliable access to basic facilities like lighting, sanitation, and water. So this is a place which is located in Raichur. The community has no predictable cropping patterns, growing different commodities like cotton, jawar, but this is not sufficient to meet their household requirements. Now, there are many such people across India, in the remote places. There are many such people who are barely able to meet their requirements. The problem is that such people are also not banked. They are what we call as the unbanked population. Okay, so how do we reach to these people, to those kind of communities who are untouched by the financial stream? And if you're not touched by financial stream, then they don't get the lending that is required for them. Okay, there are no banks out there. Okay, and even if there are banks, there are a section of the community which the banks don't want to touch because of the high risk that they carry. So we have today with us Meghna Suryakumar. So let me give you a brief about Meghna. You will see soon a slide on about her career. So Meghna Suryakumar is a lawyer turned business leader who has founded Crediwatch with the aim of providing financial access and mobility to millions of unbanked businesses. Okay, so like I said about this small place, that's where she is kind of one of the places. Like those are the kind of people she kind of gives banking facility or lending facility. Her vision is to remove barriers to trade and unlock value for business using cutting-edge technology and building a culture of trust in business. Prior to founding Crediwatch, Meghna ran a cross-border law firm based in India and the USA, where she used alternative sources of data to access risk for target firms in mergers and acquisition deals. Meghna received a law degree from Bangalore University and Columbia Law School and has a certificate in entrepreneurship from Stanford University. Welcome, Meghna, to this show of Business and Banking Dialogue.
Yeah, hi. Thanks for having me on your show.
Our pleasure. Good evening. So, Meghna, let's let me ask you my very first opening question. What are your observations to overcome the shortcomings in enhancing credit disbursement and make lending more inclusive? I did mention that in the opening remark that there are a lot of people. Let's assume there is considered that across the world, there are something like 38% of all adults globally who have no financial access. Okay, so what are your observations to overcome the shortcomings in enhancing credit disbursement and make lending more inclusive?
Sure. So I just want to set some context,
Yeah, sure.
Before I answer your question, right? So if you look at the landscape in India, the access to credit issue, there's an issue with respect to individuals. There's also an issue with respect to small businesses, right? What Crediwatch really focuses on is to make thin files thicker of unbanked or underbanked businesses, right? We don't focus so much on individuals or retail credit, but what we're trying to focus on is to solve for the problem of lack of the right credit or credit at all for businesses in India. And why do we focus specifically on this persona of business entities in India, right? If you look at the overall, landscape in India, small businesses, it could be a small agricultural businesses in the little town that you described, right? Or it could be a little store, kirana stores here in Bangalore, or it could be a small one, a weaver somewhere in Kanchipuram, or it could be a manufacturing facility in Pinya, right? Or it could be, a trader in Avenue Road, or it could be a trader in Crawford Street in Bombay, right? So it doesn't matter what the persona of the business is. Any business, as per the definition of the government, whether it could be run by an individual or it could be run by a small partnership or a group or even as a very small company, if they are between 1 to 250 crores in revenue, I'm sorry, 0 to 250 crores in revenue, they're considered a micro, small and medium business, right? And if you look at the entire credit landscape in India today, only 15% of such businesses have access to credit, and 85% of them, right, whether it could be a small agricultural business, farmers trying to, farming business, it could be based in a small town, or it could be a factory. Only 15% of such businesses have access to credit as of today, right? And in that, only, let's say 98 or 99% of them actually have this credit facility only because they have, given a mortgage of their, a house or any real estate that they own as a collateral to get this loan. So there might be a very small percentage of these businesses that have gotten an unsecured loan without any collateral. And also the interest rates at which the 15% have got loans are very high, 16 to 24%. Whereas if you look at an Infosys or a Reliance, they get credit maybe at 7 to 8%. So there's a huge disparity, right? And this is the problem exactly that Crediwatch wants to solve by being an enabler for financial institutions and by working with small businesses to empower them to represent themselves better with their partners and with their lenders. So why do we have this problem? Because if you look at a file, right, what we call a thick file of a company like an Infosys, it would run into 50 or 100 pages, a credit memo that's prepared for them to be eligible for a loan. You may not even find 1 or 2 pages worth information when you want to evaluate a small business like the type that I describe for risk. And even if you look at financials, right, a lot of these small businesses, one of the big drive in the last 5 years is for them to even get a formal bank account, many of the small businesses, right? They've also been businesses that they have been basically operating using cash, right? And now the first step towards financial inclusion was to get 100% of the country to have a bank account. And I think the government kind of has done that with the, the Prime Minister's scheme for opening bank accounts through the Aadhaar-based system, right? And then you have all these schemes and subsidies and monies that have been distributed to, people who are the underprivileged have been through using the Aadhaar number and through a bank account that the government has helped them open, right? So I think 80 or 90%. I think there's been a penetration in the last 5 years in terms of people having bank accounts now. So that's been a first step towards financial inclusion. And the second aspect is now credit, right? So because small businesses don't have enough information about them, bankers would find it very, challenging to be able to underwrite the small farmer in that little town you described, or to underwrite a business based in Avenue Road, or to underwrite that small factory in Peenya. So what Crediwatch has essentially done now is to ensure that there should be a better way to look at these businesses. So if you look at the entire landscape of small businesses, only 4% of them, have a formal credit rating, and 96% of them don't. So the first challenge that we need to solve, right, to answer your question, is to be able to look at how the 96% of the entire universe of small businesses and the business entities in India, right, and the underbanked, the 85% of the entities that are underbanked, how do we look at them in a better way so that you could, how do you evaluate them for risk in a better way? Are there better data points for lenders to understand them? If there's more information and transparency about them, right, and lenders are able to trust them better, then they would become more eligible for financial inclusion. So the first step is to build a digital trust.
Okay. So we are talking about businesses, the micro and small scale businesses, which are enabled, and perhaps also thanks to Jandan and others, the more people are in the bank account, so that has perhaps helped yours. So in this process, Meghna, what are the systematic flaws in credit growth or credit quality in the unbanked segment? And what are your recommendations? And now that the budget is also coming, so you may want to have some say on what are your expectations out there.
So in terms of the systematic flaws, I think one was that for the population size that we have, for the amount of borrowers, I think that there was not enough scale in technology to be able to provide better services to the borrowers, and also to be able to evaluate the entire credit process itself. It was all done very manually. So one of the biggest systematic flaws that we had was that until very recently, most of the credit process was very manual. And because it was very manual, there was a lot of errors. And because it was very manual, you didn't have the ability to reach out and scale your business to get, more, to reach out to a larger set of borrowers, because you had limitations. And because the whole process was so manual, even monitoring the borrower after dispersal was a manual process, which is why we've had the highest rate of NPAs, right, in the past few years, right? India's had a very high spate of fraud and NPAs in our banking system, because we did not have the right checks and balances, and especially technology, to be able to manage the scale of these operations. And I think largely after what happened with ILFS, 2 years ago, the Indian banking sector, I think, has kind of really gone through a complete revamp. And even PSUs, from PSUs to cooperative banks, to the new fintechs, to the NBFCs, to the private banks, they're all undergoing a digital transformation, right? So that's, so they're trying to fix this problem that we had, which created a lot of systemic risk. And we had huge losses in terms of the amount of frauds that happened in the past 5 years, and also in terms of the NPAs and the loan defaults.
Okay.
So now, in terms of what we can expect in the budget, right? What has happened, I feel, especially because of the pandemic, let's say 20% of the businesses have almost been tested. They're almost at the brink, right? They're in a very precarious position. So we have to really take a bottoms-up approach with this budget, right? That's my view personally, where we have to really look at what are the real ways you can speed up the growth of these businesses and help them to revive, right? And the first step to be able to do that is to be able to take stock of who these MSMEs are. So one of the things that the government has started during the pandemic is the Udyam registration process, where small businesses can register on this portal. I think that whatever businesses registered in this portal during the pandemic, the government has been actually being able to help them to kind of write to their creditors, because and wherever they had they weren't getting paid by their customers, and especially large corporations, and have told them to pay up, and a lot of recoveries happened because of the intervention. So one of the things that we really want the government to do in this budget is to incentivize. That portal may have maybe 45-50 lakh entities, right? But we have 60 million small businesses. If you're able to get all of them into this one system where they could and incentivize them to do that, I think having them there, and then once you have all of as many entities as possible, like how you had the Aadhaar registration drive, right? And then you were able to systematically introduce so many subsidies and so many schemes, including the Jan Dhan Yojana, then the health insurance. There were many kind of different policies that were able to effectively reach the lot. So if you put all of these 60 million businesses, they're able to effectively register in this Udyam portal, and then the government knows who they are, what their identity is. Then they should come out in this budget with a slew of incentives and policies to revive these entities, just like how they did with the Aadhaar. And how because 80% of them got bank accounts, I think that 4 to 5% of the country has actually been lifted out of the poverty line. So to make that kind of impact, that's what we need from the budget.
Okay, good thoughts. So your with the current crop of MSMEs, they are all struggling. There's no doubt about it. Most of them. Is Crediwatch looking at these businesses to lend?
So we don't lend. We enable financial institutions to lend. So
Okay.
I'm a partner with banks. I'm a partner with fintechs. I'm a partner with financial institutions. Right? Crediwatch is a partner to all of the lenders, irrespective of their shape and size. And we help them evaluate these businesses in a better way. How do we do that? We have something called the Crediwatch Trust Score. So where we are able to analyze these businesses, which typically would have been a 1-page or 2-page file, we might be able to create 5 to 10 pages of credible information about them, positive information about them, that would make them eligible for a better interest rate, or make them even eligible for a loan, because the bank was actually not looking at those aspects, right? For example, earlier in the traditional way, they would say, give me 3 years balance sheets if you want to qualify for a bank loan. But now, if we could say, give me 6 months of your GST returns, right? Because that's more relevant than the fact that you may not even have a 3-year banking history. Yeah. Right? And that's the power of alternative data. Then you also look at your compliances. If this company or the small business is filing GST every month, without fail, that means that they will also probably be paying their taxes on time. They'll probably even repay their loan on time. So a lot of these behavioral aspects of MSMEs and small businesses, if you look at the whole scope, if you look at the universe of defaulters, they're a very small percentage. It's the larger companies that actually default. So smaller companies, if they have the means to pay taxes, if they have the means and ability to do it, they will be mostly compliant and they would do it. So there's a lot of things, that alternative data points about their behavior, that could actually make them more eligible for a better interest rate. So we bring out these kind of salient aspects on small businesses, and we create this file about the small business on the basis of which the bank would take a decision to lend or not to lend to the particular business. So that's kind of what we do. We're an enabler.
Okay, so basically you are enabling the small businesses. You kind of, if they approach the bank, they may not be entertained because they don't have those kind of credentials. So you make it possible for the small businesses to have those kind of information and credible looking at the businesses, and you enable them. That's a great thing to do. So do you see in the current pandemic, now that it's getting perhaps hopefully getting over, do you see a lot more credit offtake from MSMEs? Are you seeing a lot more applications coming to you?
So applications don't come to us, they come to the bank directly, right? Okay. We are very neutral, we are impartial, right? That's the thing about Crediwatch. That traditionally, there would be an entity called a DSA, where they would take the file from the small business and they would take it to the bank. and they would charge a small percentage if the loan, is successful. So we're not the middlemen. So we are a technology company. You can think of us more like a Sybil for businesses. But we're not giving a credit score per se, we're giving something called the trust score. And banks have started to increasingly rely on our scores and our analytics and our risk analytics to make decisions, right? And so we are more like, so there's an entity called FICO in the US, which kind of revolutionized the way you give home loans to individuals in the US, right? Because it looked at a very alternative way of assessing the individual rather than just his financials. It was more on, in terms of a lot of alternative points about the individual that would give him a FICO score and not just his bank balance, right? So from that perspective, Crediwatch has created this unique trust score, and how the FICO score has really revolutionized the home loan market in the US, but it's an independent technology company that gives scores, right? It's not like a regulated entity. It's not like a Sybil. Similarly, Crediwatch is that kind of a independent technology company that provides these risk scores about businesses, and it can be used by the business themselves, or it could be used by the bank, and on the basis of which you're able to make a much more reliable assessment of the borrower or the counterparty you're dealing with.
Okay, got it. Right. So you're a technology intermediary company.
Yes.
Yeah, that's great. Okay. So in your perception, Meghna, what is the state of credit inclusion across the country, and what's the progress made in the last few years?
So while I think there's a lot of progress made in terms of financial inclusion for individuals, right? That's mainly because of Aadhaar and all of these initiatives that we've actually, I was actually on a panel a few months ago with the United Nations Development, UNDP. And we were talking about how, the policies in India have actually, how do they align with the sustainable development goals? And we did a lot of research where we found that 80% of the people in India already have a bank account thanks to Aadhaar because of the Jan Dhan scheme by the government, and how subsidies are so effectively reaching the individual beneficiary without a middleman, whether it's your gas subsidies or whether it's any money that they would have got during, for under any of the schemes, and even the health insurance, that the free health insurance that the government has announced of, up to 5 lakhs for people who have a certain, income level. So there's been a really positive impact because of our Aadhaar initiative, right? But when we look at what is happening with respect to small businesses, right, in terms of financial inclusion for businesses, there a lot has been done. Like we have the first thing that's important in trade is for you to be able to send money and receive money easily. So in the last 4 or 5 years, because of UPI and the entire, the Aadhaar-enabled payments, the UPI, and the entire infrastructure that the government has created, the stack, right, the India stack, there's been a lot of, the ease of receiving and making payments has really been a very positive thing for business, especially for small businesses, right? Now, even a panwala has a Paytm account with which he can take money from his customers, the local business who does, maybe who irons clothes for the entire locality. So in terms of the first step to enabling financial inclusion is to be able to receive money and send money easily. That's how you accelerate trade. So I think a lot has been done to the extent that the total number of UPI transactions, I think this year overtook the number of ATM transactions in the country, right? So that's been a great positive step. And then the government is building layer by layer, right? After the UPI, then they're looking at the account aggregator framework. That's what the RBI came up with, where the government has also recognized that there could be alternative data points and financial data points about you, data framework itself, which could enable different kinds of credit and trade transactions, right? So the government has done a lot of work. The RBI has done a lot of work in coming up with something called the account aggregator framework, where companies like Perfios and Yodlee and Setu, I think they're all becoming, Setu I think is about to become an account aggregator, but Perfios already is, where they're intermediaries who can collect certain kind of financial data in a transaction between a lender or like a bank and the borrower, an individual or a business. And that's kind of, again, to be able to do that is the first step, I think, towards getting into an open banking initiative in the future. And now you can easily, with an OTP, share your GST returns in a secure way, share your bank's financial statements to get a loan in a secure way, or your income tax returns and things like that, right? So that's been another step, to be able to share data in private data, secure data, to help for a benefit like getting a loan. And for small businesses who don't have technological means, or individuals who don't have those sophisticated tools and CA departments to create all of those files, for them to be able to share data seamlessly, I think that was the next step. And that's kind of underway now, right? And then the third step would be now to actually design the right kind of products and services, and to convert all of this information that you would get from this data exchange and data sharing into a meaningful score. Because I mean, it's very clear, like if you have a 750 civil score, then you're eligible for a home loan at this interest. You're eligible for a credit card at this interest. But there's no benchmark. What is the benchmark to get a 1 crore loan? What's the benchmark for a 50 lakh loan? What's the benchmark for a 10 crore loan? We don't have that, right? It's very subjective with the bank, the relationship the business has with the bank, and the financials and the performance. It's a very subjective thing. So now with all of these moves, we need to objectify and make it objective. So let's say that if you look at the same scale, right, 1 to 900, like CIBIL score, right, then there should be a benchmark that says 600 should get you this, 700 should get you this, 800, because even the small businesses themselves have to work towards improving their score and credit, right? Otherwise, how would they then how would they be able to do business and get a larger loan facility if they don't have the means or the understanding that what do I need to do? It's so easy for an individual. Say, I need to do this and this. Now I'm eligible for a credit card. If I do this next year, I'll be eligible for a home loan. So we need to make this so objective even for small businesses in a simple and easy way for them to understand, and offer financial products and services that's relevant to them. So this is now happening slowly, right? This has just started. So only when the banks being proactive to offer very customized loan products and services to suit these businesses, that has to happen, just like that's happened at the individual space. And second is that we would need more people, more companies like Crediwatch to make this very objective, so that it's very clear in terms of for the businesses themselves to know what they need to do to get a loan.
Okay, yeah. Yeah, very well explained, Meghna. Thank you very much. We have, ladies and gentlemen, this is we are talking about credit lending to the unbankable businesses, perhaps, or lending to those businesses which are perceived as risks by the banks, and that's where Crediwatch comes into helping the banks to get a better idea of the businesses, and perhaps enabling the businesses to get the credit. So I'm sure you have a lot of questions to ask. So you may want to put the questions as in the message box for me to ask Meghna for her comments on that, or you may even want to ask directly. Now, since we do this on a regular basis, there are already some participants who know that I'm going to say this now, so they are already ready with some questions. Meghna, if you don't mind, can I get the first question across to you? Harish Prabhu, very experienced banker, very regular to our show, would like to ask a question. So Harish, can you please unmute and ask a question?
Sure. Yeah, good afternoon, Meghna. And see, the essence of lending to unbankable entities, I mean, I by entity, I mean that it could be a person, right? Or an entity is separate, from the person, like a small business, including unincorporated ones like proprietors, is how well you create a robust alternative scoring mechanism. And as, there could be 20, 50 parameters also. I mean, it's left to your imagination, right? But this segment, right, is riddled with NIP, NTC, and BPL customers. No income proof, new to credit, first time, whatever, right? And below the poverty line customers. And I can explain you where. Who have potentially robust underlying cash flow from their small businesses or profession, right? I mean, so when you said about a milkman, right? I mean, he'll have a clear-cut sort of visibility on his cash flows, but he might not be he might not be NIP. He'll be an NIP, NTC, or for that matter, no scoring, available in CIBIL. So do you look at the lending to such people with the cash flow lending approach? I mean, do lenders purely on a cash flow lending? And secondly, if you can throw some light on the details of the alternative scoring mechanism.
Sure. Yes. So we do support.
One caveat is I was in discussions with India's largest bank, And believe me, you on a vehicle loan for his business and not personal use, let's say a rickshaw, India's biggest bank, comes completely sort of flat, falls completely flat in lending to a BPL customer. So that's why my question.
Sure. Yeah. So, yeah, let me answer your question part by part, right? Do we support flow-based lending? Absolutely, yes. So that's why I was talking about account aggregators when just a couple of minutes ago. With the AA framework now, we are able to get data in the flow of a transaction, right? So, and also there's a lot of initiatives now in the ecosystem to push flow-based lending. You have the Open Credit Enablement Network. That's an initiative of iSpirit, where they're extending the stack to build a framework where banks and loan service providers and new type of entities can collaborate to offer unique type of financial products and services right to the BPL customer, the milkman, the persona that or even the flower lady, to small businesses, which could range up to 250 crores, right? The range is from 0 to 250, if you ask me. And because you're able to get data in the flow now, like because you have companies like Khata Book, you have companies like OK Credit, you even have companies like Paytm who offer wallet services. With the permission of the customer, that data is actually whatever they interact even on their wallets or on the apps where they keep a track of all their incoming and outgoing as a very small business, like a flower shop lady's accounts, right? It kind of really gives you a good insight into the kind of income they have and the amount they can repay. So if this data is kind of plugged in the flow, it's very easy to offer a loan or instantly to the flower lady or to the milkman, right? And to the business that's trading grains in Avenue Road based on the last 3 to 4 months turnover, just GST data given at a consent within few seconds. You can see what's the quality of their customers, how many vendors do they have, how many customers do they have, are they, all of that, right? And a simple button to click access to your bank account for a trader like that, you would know whether the customers are paying the invoices that they've raised in their GST returns, because you can collate the two. So that kind of technology is now available to do flow-based lending. And from the persona of a milkman to the persona of a small business, a medium business or a large business, they can all be beneficiaries by sharing data in this flow, right? That's very much possible. And if you look at marketplaces like Swiggy, Zomato, all of them are partnering with banks to be able to offer, based on the transactions and the number of orders a restaurant receives on their platform, they're actually going to be offering different financial solutions for the restaurants on the platform. So all of that is actually happening now in the ecosystem to enable flow-based lending.
How far away
And
are
in terms
we
of,
from?
yeah.
I mean, I'm running a similar business where BPL customers, and we've been talking to banks, but how far away are we from all this account aggregator, OC, everything coming together so that we can really, is it like in the immediate future? Is it
It's
like
in the
2 years?
immediate future. There are lots of pilots happening where some of the very large banks, like the banks you've mentioned, are collaborating with fintechs to come up with products and services. In fact, I think Idfc Bank just launched a credit card last week. Of course, it was not for BPL customers, but at 7% APR instead of the 24 to 40% APR that we had. Based on this kind of alternative scoring that they'd be doing on their customers and underwriting this product. So alternative data points that we would get, from past transactions, apps where payment apps that merchants would be using to get their receivables, GST data, bank account data, all of this can really give a much more robust picture on the business, and that can definitely be used to underwrite to give them the appropriate credit for that kind of relevant to the information they've shared.
Okay. Thank you, Harish.
I think all the banks have loan under 69 minutes now, right? I think that is another initiative that's getting a revamp now. They're going to come up with version 2.0, where there's a lot more done in terms of automating the process and making this process much more easy for the small business to apply for a loan.
Thank you, ma'am.
Thank you,
Yeah.
Harish. So I have another question to you, Meghna. It has come from YouTube. So, says, can you give us a case study of a lending you have done to a section of Unbankable, and what has been your result, or what has been your experience? You need not mention the name of the company. So, if you can give us an example.
So our customers have definitely lent to SMEs. So with several private commercial banks, Crediwatch, in fact, one of the first assignments we had when we set up, right, back in 2016, was when we gave a data APIs to Capital Float. That was the first NBFC fintech company in India to start providing loans and financial products and services to the underbanked small businesses, right? And we were one of the first vendors to work with Capital Flow. This is in 2016. Similarly, I mean, I can't give names. So even with RBL Bank for the SME retail segment, which is largely focused on these sorts of small businesses, we've been our data APIs has been integrated with the loan origination system, where there is all of these alternative data points are provided, and that helps them create a credit memo on their customers. So this is something that we've been doing from 2016 itself. So in terms of the overall impact, I think that I think that small business lending in India is just beginning to take off, right? Because all of the entities that are actually robustly involved in small business lending are fairly new. If you look at Lending Card or look at Capital Float, and look at a lot of these new age, if you look at Sanumati that lends to, agricultural, in the agricultural business. If you look at, there are other Varthana that lends to entrepreneurs who are setting up schools in tribal areas, remote areas, and in fourth tier, fifth tier cities and villages in India. All of these businesses are hardly 4 to 5 years old. So I think that to really assess impact of whether small business lending is at an impact, you need a 10-year story. Because even in the US, after 10 years of Lendo and all of those lending companies, they were able to do some realistic analysis in terms of what worked and what didn't. So we're still we can say at the halfway mark, and it's very early to be able to right now quantify it.
Okay, thanks. So I have another question coming to you directly all the way from London. So Mr. Kaza would like to ask a question. Mr. Kaza, please unmute yourself and ask the question. Mr. Prabhak Kaza.
I'm sure we had the 2007-2008 financial crisis in the United States. It was mainly because a large number of persons who didn't have credit score, who didn't have any proof of their finances, ended up getting massive houses, not one, not two, but three, landed the whole world in a $1.5 trillion loss, made even Goldman Sachs beg from the government of US. And I'm sure also you know why government of India escaped, or India escaped, because we didn't buy junk bonds, we didn't go much into derivatives. And when I'd asked the Governor Reserve Bank of India at that point of time, why on earth we don't have derivatives like the rest of the world has got, because you can spin off and lower your risk at each and every stage. He said, look, I've escaped during my term by saying that I don't understand derivatives, and what I don't understand, I cannot regulate. And this kind of financing persons whom you cannot supervise, you cannot monitor. If few companies here and there finance, nothing much happens. But if this catches up, it could be a total national disaster. Because even in a regulated industry like banking, you have so many non-performing assets. And must have read in Vijay Mallya is not going to come back. So with stories like this, I don't know where we land the country if we start financing the unfinanceables. Just a comment if you don't mind. Thanks.
Yeah, so I'll respond to that point by point, right? What happened with the US financial crisis in 2008-2009 is mainly because they issued loans to homeowners who were not eligible for it, and without oversight, right, without proper due diligence, and they just issued loans to everybody. Second, they combined those loans into derivatives and sold them as AAA bonds when they were actually junk bonds, right? So that's why the whole housing market collapsed. Now we don't have the derivative market in India, right? The bond market at this point is just mostly purely debt, right? So from that perspective, we're talking about very different kind of economies. And while America is completely capitalistic, the Indian economy itself, although we say we are a capital economy, we're more like a mixed economy. So there's a lot of control and in terms of how the government makes regulations, and banking is an extremely well-regulated sector. And second, even NBFCs, the fintechs, a lot of them who are into lending today, they're all regulated, right? Because you cannot lend us beyond a certain threshold if you don't register to become an NBFC. So because of the fact that most of these entities who are lending now, who are going after the underbanked, are all regulated, it's very unlikely that why not just America? The same thing happened with China. They're dealing with, billions of dollars of defaults because they really went berserk in terms of just issuing loans worth of billions of dollars, doing peer-to-peer lending and all of that. And they have a huge systemic default now, right? And there's a lot of a slap on the wrist for a lot of fintech companies and large technology companies in China today. But in India, we've had a more careful approach. And in fact, the way the Indian template of what we've done in terms of the technology infrastructure and the policy push to enable financial inclusion is actually a template for the world to implement and learn from us. Right, what we've done with the Aadhaar, what we've done with the UPI, what we've done with all of the different infrastructure stack, what we're doing today, it's a template that the other countries are actually actively, learning from us, and they're going to implement elsewhere. So it's a very different situation. Because the way we are approaching it, even when we're looking at doing alternative score, it's from credible data, right? It is from your valid GST returns. It's from your valid bank statements. So it's from credible, reliable information that you're creating a more positive picture on the small business. And there's a lot of checks and balances in place, right? Even for lenders themselves, there are a lot of checks and balances for them to issue a loan, whether a small lender or a big lender. So we're looking at a very different market. And in fact, we would be the template for the world.
Thank you. Thank you, Mr. Kaza, for an excellent question. Meghna, let's look at the underwriting models. Okay. So some of the new age underwriting models using technology, artificial intelligence, big data, what have you, have eased credit access to MSMEs and small businesses. Have these models been useful in accelerating lending to the underbanked or unbanked? What has been your experience?
So we were, in fact, Crediwatch actively uses machine learning and artificial intelligence to evaluate businesses for risk, right? And we've at this point assessed over close to, let's say, about 75,000 businesses so far. We have a product called Early Warning System, where banks get to monitor their borrowers post-lending. And this could be a proprietor or a small business or medium size or even a large business. Because the core of the problem today is to be able to assess whether or not a company is likely to get financial distress. That's how you can reduce the NPAs, right? So with this kind of machine learning that we've done, actively studying default and actively studying how companies behave and how they function, we've actually been we've been able to come up with something we call trust score using machine learning. And this trust score is a set of parameters that Crediwatch has come up with, which we feel are the common identifiable factor that shows positiveness about an entity irrespective of the size. And that's the outcome of the machine learning and AI. So definitely, if you look at lending as an industry and banking as an industry, the future is that these industries are completely digital, technologically enabled, and they use AI as a strategy. Because if you look at if financial institutions across the world, wherever they are, if they don't use AI and machine learning as their core strategy now, they're going to be left behind, and they're probably going to even suffer in terms of their business profits. So across the world, whether it's in India or wherever, banks and financial organizations are seriously looking at AI as a strategy for them to be able to grow and to be able to reach out to new segments of customers, especially the underbanked customers, and look at innovative ways to be able to offer financial products and services to them. And the IDFC credit card that was released last week, right, at that 7% APR is the first step towards that kind of innovation.
Okay. So do you see more and more of new versions of underwriting models coming up using different types of technologies?
So there are different, depending on the type of business. I think there are many companies that are working with banks, right from rating agencies and bureaus, whether it's like Sybil or any of the other bureaus, right? All of them have come up with some unique, I think, unique, let's say, modeling based on the data that they have that they're providing to the banks. So depending on the segment, there are many fintechs and technology companies that are working closely with the banks to use the data to be able to help the banks design better products and services.
Okay. I have another question coming from Mr. Pushpendra Khandelwal. He says, he's talking about, as he says, as you point out, for unbanked micro entities due to unavailability of collateral, but government has already instructed to PSUs not to impress about collaterals to a certain limit. So he's asking a suggestion, he's giving a suggestion. Can government make an institute for country level where all needy persons can apply, and after scrutiny, the institute will send the application to the financial institution as per the area with strict follow-up and security guidelines with guarantee scheme? Are you getting the gist of it?
So the credit guarantee scheme, if he's talking about, we already have several credit guarantee schemes, right? With the PSUs and even with banks, government already has a scheme where if you're an entrepreneur, you can get up to 1 crore collateral-free debt, where it's insured by the government. This has been there for a few years already, although it's been very sparingly used, right? Where entrepreneurs can get up to 1 crore of credit facility with a bank. This is even prior to the pandemic. Provided they meet certain criteria. This 1 crore, I think, is underwritten by the government of India. We already have this, right? So the point is that I think that the banks issued loans under this scheme very, very sparingly. And now I think with the advanced technologies that we have for banks to be able to understand these entrepreneurs, because typically if you require a loan up to 1 crore, whether it's 5 lakhs, 10 lakhs, or anything up to 1 crore, you're really a small business. And these are the businesses that find it extremely challenging to get a loan, because that's the sweet spot where most of the fintechs are lending, right? 25 lakhs, 50 lakhs, because those are the areas where you find a lot of underbanked businesses. So I think that with the application of the new underwriting technologies, the schemes that we already have can be implemented more effectively, right? And then there was the other credit guarantee scheme that was during the pandemic. That is, there are 45 lakh entities in India that already had an existing relationship with the banks. And, they would have OD facilities, and there would already be a loan facility, maybe against the collateral. So there, during the pandemic, these businesses got an additional 20% increase or enhancement in the credit facility without any additional collateral. And they just got that without any paperwork. But that is just a temporary thing, because that 20% would not really cover everybody's needs during the losses. But it's more of this 1 crore kind of, schemes that the government has for, small businesses, which all banks can widely implement. These kind of schemes should be more effectively implemented, and that would probably be a better answer to the problems.
Okay. But, when you talk about this 1 crore no collateral guarantee and all that, it's good to hear, and there's so many schemes are there. But the experience of many of the businesses are, when they approach the banks, there is always a caveat to that. Either we have not got instruction, or we don't give to you. We only give to manufacturing. We don't give to services. So many excuses, and with the result, credit doesn't just flow.
Correct. That is exactly the problem we're trying to solve. It just doesn't flow. but it will take time.
Okay, all right. Okay. Um, so let's talk about some technologies. So what technologies are going to shape the future of credit intelligence?
So definitely it's going to be AI and machine learning is going to shape the future of credit intelligence, because you get a better understanding of risk, you get a better understanding of the borrowers, and also you get so much of tactical knowledge to help you design new financial services and products based on the kind of insights that you get from the data, when you do machine learning on your customers. Like you could be able to offer a completely different kind of a loan with a completely different kind of an interest rate because the data told you a story. So that's the future of credit intelligence.
Okay. I don't know whether you answered this, but the question is, how do you evaluate credit worthiness of an unbankable business or a group of community trying to do a business? And what are the one or two
So,
steps?
so first I would not use the word unbankable. I'll say unbanked or underbanked, because
Underbanked.
nobody
Okay.
per se is unbankable.
Okay.
So yeah, and I mean, if you have to get a business loan, right,
Yeah.
you need to approach a lender. And second is you should be able to share data, right? So if I was an underbanked business, then I would ask myself, what is the best foot forward for me? Is my business really fueled on past transactions, where I'm a merchant and the number of swipes that happen in a day kind of tell me a robust picture on my business, and am I willing to share that data, right? Or is it that I have, the kind of robust sales that I have on a month basis with my GST data that would paint a better financial health rather than my last 3 years financials, right? So, or is it that if someone looks at my GST returns, the quality of customers that I have would give the bank the confidence that this particular small vendor actually has such large institutional customers, so we would expect that he would do well. So businesses should now be able to be more open to sharing data, because if they share more data and data becomes an asset instead of the mortgage or the real property, banks would be in a better position to be able to evaluate them for risk. So I would tell, whether it's a community of small businesses or a small business themselves, I would say be open to sharing data, right? Be open to adopting technology yourself so that you can share data better. Whether it is for a small business to get an accounting system, a lot of solutions are available, right? Or a small business to be able to even use an app like Khata Book or OK Credit, where data can be captured. So different ways, there are different tools for small businesses to get digitally rich today. And I would urge small businesses and entrepreneurs to get digitally rich by enabling technology in their day-to-day practices, whether it's just using a simple app like a Khata Book or a Paytm, or using a card for swiping machines instead of cash transactions. If you participate in the digital economy and you become data rich, then there's definitely you stand a very good chance of getting a loan at very competitive rates.
Okay. Well, that's a good advice. Rather than just being manual, you're saying start using technology for
Yeah.
your accounting purposes. Okay. It is one other question comes up is everyone should be eligible for a loan for essential business ventures, but they should be able to pay it back while not having to pay exorbitant interest rates. Finding that balance is crucial for our project. How do you make that fine balance in your experience?
So, yeah, if you have to get better interest rates, then it needs to get competitive between the banks, right? So there are many forums that kind of are offering that now, like a reverse auction mechanism to get more competitive interest rates. So one such forum is RXIL, which is the Trades platform. There'll also be the M1 exchange. So these are instituted by the government, where any corporation over 500 crores turnover or any PSU, they need to be able to offer invoice discounting facilities as a mean of financing to all of their suppliers and vendors, right? So that's a mechanism that's available. So suppose your customer is a corporation who's over 500 crores or is a PSU, then you already have a way to get better interest rates. because you can participate in this process, and like the TEDS platform, right? That then you would have, I think there, some in the reverse auction, many of them are actually getting 7% interest rates and things like that. So there are mechanisms now where it makes it more competitive. The second thing is there are now a lot of marketplaces. You have Idfc, SME Corner, you would have many other marketplaces, bankbazaar.com, right? Where you would be able to get more competitive interest rates, because you're going through these platforms. And I know that in the new avatar, many of these platforms are going to be actively working towards providing more, this kind of a more competitive interest rate to members of their platform. Also because the members are going to be sharing some extra data about them, right? And also if you look at many other marketplaces, I think even the government's GEM marketplace might be working on a project where anybody who wins a contract on GEM is automatically eligible for financing the minute he wins the contract, or he or she wins the contract. And there again, they're using the data of past performance of fulfilling other contracts. It can be a simple contract for supplying chairs. It need not be a multi-million-dollar. It could be a contract for 5 lakhs to supply chairs to some government department. It could be a small, anything for any kind of goods or services. Suppose your customer is a government entity, then on the GEMS platform, they're able to get easy access to finance. And there are many, so whether it's from the private fintechs or whether it's from the government, now there are many avenues to look for competitive rates. And you should shop around, right? There are so many NBFCs that provide new NBFCs that are providing, financing, especially, and they're also financing like the specific NBFCs that finance manufacturing entities. There's specific NBFCs that finance a supply chain. There's specific NBFCs that would finance, let's say you're in the milk production food chain. There's an NBFC, there's a company called Stellaris where they, whatever supply chain it digitizes, it partners with the bank, takes the risk and offers a very competitive loan to the entire value chain from the time that the milk is produced, the cow with the farmer, till it reaches the end customer. All of the SMEs involved would get access to finance. So there are avenues available. You need to research it, and you would be able to get much better rates.
Okay. From a regulatory point of view, what is needed to get, for to enhance or to enlarge this credit enablement to small businesses?
I think the government has kind of done everything it needs to at this point. I think one of the things they need to do, I think, is more innovation in terms of reducing the paperwork. There's a lot of paperwork we need to sign to get a loan, right? And we have a lot of rules from the RBI on original, seen and verified, in-person, face-to-face verification, all of that. There's a lot of new technologies like video KYC and e-sign that can, e-stamping that can really make lending seamless, and, literally within 4 to 5 steps, you can get a loan. And while the government has made some policies towards all of this, still there's a lot of confusion in terms of, how to do complete, contactless KYC as to whether you can only do that for individuals, whether you need to do it for businesses. Where does video KYC, is it only for individual loans? Can we do it in the context of a business loan? So if the government kind of provides more clarity and pushes more towards whether it's a business loan or an individual loan, towards 100 enable policies to enable bankers to make it a complete digital process end to end, I think that's going to really help push towards more financial inclusion.
Okay. We've come to the end of our 1 hour, but just a couple of minutes, Meghna, if you don't mind.
Sure.
So one question that has come is, how do you find such people or communities in the remotest places, considering India is such a large country? How do you keep up contacts with them? I don't know whether it's relevant to your business.
Yeah, in fact, that's exactly what we're doing at Crediwatch, right? I have a platform with digital footprints of over 10 million entities, business entities in India today. And my goal is to try to see if we can get as much of the 60 million entities that exist. So the first thing is to be able to, that's why I keep saying that small businesses need to go digital. So if there is a digital footprint of the small business, then they can be discovered. So if credit has to reach remote corners, they need to be discoverable, right?
Yes.
Otherwise, you have to rely on a local branch, that could cater to them. But many of these digital lenders are all completely online. They don't have branches in every state. So I think the first step is actually discovery. And for that, businesses have to go digital in some way or the other, and that would help them get discovered.
Okay. So the final question is, to tell our audience 2 or 3 main points to make it possible for them to get credit. One of them is go digital. That's very clearly you mentioned that. Any other points that you would want to put it from before them?
Yeah, one is go digital. Second is, build your business credentials, right? One is just going digital. Second is making your presence felt, right? So, and third is conveying that to a potential partner or a lender. So small businesses, there are a lot of tools, digital tools available for them to present themselves better. Whether, you can now get a small business website at a click now. There's so many people offering these services, but you can get yourself a website at, maybe 500 or 1,000 rupees, right? You can immediately go digital on payment with just a click, just downloading a simple app like Khata Book or OK Credit. You can enable payments where you can just send WhatsApp messages to your local customers and they can just pay you back, and that gets tracked on the app, and you have your entire ledger ready. So they're very simple. So it's not just going digital would mean that taking a little more extra step, right? Go take the extra step, go get yourself a website, go list on platforms where all SMEs are, right? Be more, network more, be more proactive. So the more visibility you give yourself as a business, right? Because the traditional makeup of a small business is he's very local or he's very hyper local. But I think that the new age small business in India, whether they're in the remotest corner, whether it's Kashmir or Kanyakumari, if they're able to reach their customers or partners across the country by going digital, by putting themselves out there, by networking digitally, I think that that's what I would advise them to do, right? And that's what they should be doing, because then there will be more data available to underwrite them, and they would get better loans, right? And then they would get more customers because they are more visible and other people can reach out to them.
Yeah. Okay. Well, ladies and gentlemen, it's 1 hour since we have started talking to Meghna, and so I'd like to draw end to this show. Meghna, thank you so much for coming over and talking to us. Ladies and gentlemen, I leave you with this thought. As per the latest, India has crossed 41 crores in Jandan account, bringing the unbanked population within the basic financial stream. Okay, that's a very, very important thing. The need for business credit will be much more now, because as the pandemic, hopefully coming to an end, there will be a lot many more people who would like to do business rather than get employment, because the employment will be scarce, because every business is relooking at their own business models. So employment perhaps may not be there or may be scarce to get. So you may want to look at startups as one of the ways of doing businesses, and definitely you need credit for that, okay, to move ahead. And so some of the thoughts that Meghna has told us, one of them is being digital, being visible, is so very important. So I think with that, I would like to end this session. Meghna, once again, thank you so much for coming over, and perhaps look forward to you in some other show in the near future. Thank you so much.
Yeah, thank you. It was a very engaging conversation. I enjoyed it very much.
Thank you, Meghna. Ladies and gentlemen, thank you very much. Good night and good evening to all of you. Bye-bye.